The first explanation is about the markup and margin. So speaking about margin means, okay, they are showing your gross profit as a percentage on your cost of sale, on your sales, okay, and margin is gross profit as a percentage on your markup. So margin means out of your sales, what is the percentage of your gross profit? And markup means out of your cost of sales, what is the percentage of your sales? So if you take the margin, your gross profit over sales into 100, you will get your margin. So for an example, if your gross profit is 100,000 and your sales is 500,000 into 100, let's take, so margin is going to be 20%. Okay, so markup is gross profit as a percentage on your cost of sales. Now the issue arises, okay, when they give you, okay, so they will give you that your sales is 200,000, right? They will tell you your opening stock is 100,000, purchase is 100,000. We don't know our closing stock and our gross profit. Okay, so with this, okay, they have given you the sales. Okay, so basically if you have your margin, you can directly apply the margin to the sales to find the gross profit, but they will tell you that the markup is 20%. Now when they tell you the markup, we can't directly apply because markup will be directly applied with cost of sales. Okay, so if it's the markup is 20%, means your cost of sales is 100%. Okay, so if you take sales minus cost of sales, your gross profit. So if markup is 20%, means your cost of sales is 100%. So which means your sales will be 120%. So if 120% is equals to 200,000, how much is 20%? You will have to cross multiply that. Okay. So if you get margin, then margin, if they tell margin is 25%, then your sales will be 100%. Okay. Keep that in mind. Okay. So now it's a FIFO and WACC. Okay, so FIFO and WACC, okay, it's not complicated. Okay, so FIFO means under first in first out method. What comes in first will go out from the business first. Okay, so WACC means we are going to give a weighted average, okay, weighted average cost. Now for an example, for products with an expiry period, we will transfer whatever that comes into the store first, only they will sell first. So for an example, if you take if you go to a supermarket, okay, and you look at the products with, let's take, milk, dairy products with expiry period, you will see the ones with the closest expiry date will be at the front of the shelf. The ones with a later expiry date will be at the behind of the shelf. Okay, because they want to send the goods with whatever that comes in first, they want to send it out first. So if you take the first in first out method, it's very simple. We divide the table into 3. Receipt, issues, balance, quantity, rate, value, quantity, rate, value, quantity, rate, value. So we have 100 units at the rate of 5. So the balance is 100 units at the rate of 5. The value is 500. Then we have issued 50 units. So we have only one set of inventories, right? Okay. So then I'm going to issue 50 units at the rate of 5. The value is 250. So out of 100 units, I have issued 50 units, means only 50 units is remaining. So at the rate of 5, it's 250. Then now we have purchased 50 units at the rate of 5.5. So 50 into 5.5 will be 275. I will copy paste this into the balance column. Now what I will do is I will draw a line, but I'm not going to total anything. Why I'm not totaling is I want to let it be at 50, 55 and 5.5, because so that I know that I have 50 units at the rate of 5 and 50 units at the rate of 5.5. Then I have issued 60 units. Now, which came in first? This lot 50 units at the rate of 5 came in first. So, I will first issue that 50 units at the rate of 5 I will issue. Then I have to issue 60 units. Another 10 I have to issue. So, that 10 I will issue from the second lot at the rate of 5.5. 55. So, this unit is gone. Out of 50, I have issued 10. So, only 40 units at the rate of 5.5 is remaining. Then we have bought 100 units at the rate of 5.6, 100, 5.6, 560. Copy paste this in the third column. So, this is, so under first in first out method, what comes in first has to go out first. So the thing is, under the balancing column, I'm not going to total when I have inventories at different rates. I will mention the quantity and the rate separately and draw lines and keep. Okay. So now I'm going to explain you all the So now I'm going to explain you all the 100 units at the rate of 5, the WACC method, 500. Then we have issued 50 units. So when we issue 50 units at the rate of 5, 250 is gone. So out of 100, if 5 is gone, 50 is gone, means we have 50 at the rate of 5 remaining. Now we have purchased 50 units at the rate of 5.5. I will record under receipts column and copy paste that in the third column, in the balancing column. Now when you take your, now you have 100 units, the value of that is 250 plus 275, the value is 525. Okay, so to find the rate, your value divided by now I'm going to give a weighted average, an average cost. I have 100 units of inventory. The cost of this inventory is 525. So to find the average cost per unit, the value divided 525 divided by 100, it will be 5.25. Okay. Okay. So then now we have to issue 60 units. So now when I'm going to issue 60 units, I will be issuing it at the rate of 5.25. Out of 160 is gone, means 40 is remaining at the rate of 5.25. So now we have bought 100 units at the rate of 5.560. Copy paste that in the third column. Okay. So then you will find the total value. The total quantity is 140. The value divided by 140, you will get your average cost. Then EOQ. So before I start doing EOQ question, EOQ means how many units we have to order at once so that our total cost will be at its minimum. Okay, so EOQ is equals to 2COD divided by CH, the root of it. So CO is your cost per order, D is your annual demand, CH is your holding cost. So let me take a question. Okay, so now this is monthly consumption. D is means your annual consumption. So 500 into 12, you will have to multiply to get the annual consumption. So that is 6,000. So now you're going to just put 2 into cost per order is 60 into annual demand is 6,000 divided by holding cost. So 8 is 10% is going to be 8 and the root of it. Okay. So 2 into 60 into 6,000 divided by 8 is 90,000 to 30. Yeah, so it's 300 units. Okay, so at each time you are placing the order, you will place 300 units. Number of orders per year. Now in an year, your annual demand, okay, your annual demand is 6,000 units. Each time you are placing your order, you are going to order 300 units. So 6,000 divided by 300, you will be ordering 20 times. So this is the number of orders per year. So if you want to find your ordering cost, 20 into cost per order, number of orders. So number of orders multiplied by cost per order, you will get your ordering cost. Okay. Now when they ask you to find your holding cost, then you're going to do is your EOQ divided by 2 into holding cost per unit. EOQ is 300 divided by 2 is 150. Holding cost per unit is 8. You will get your holding cost. Then you'll want a share issue. Okay, so we have three types of share issue. One is the IPO, the initial public offer, or a normal share issue where you sell shares at the market rate, you get the money. Then you have the rights issue where you sell shares at a discounted price. Okay, so you're selling shares, you're getting money. Then you have the bonus issue where you are selling shares. Okay, we are giving shares free of charge. Okay, so if you take a look at the normal share issue, 200,000 application has been received. Rejected application is 50,000 shares. So okay, now we have issued the shares at 25 each. So when you 200,000 application has been received. So 200 into 25, sorry, answer is 5,000. So you have received 5,000. So when you receive, cash account will get debited by 5,000. Share issue account will get credited by 5,000. And we have rejected 50,000 shares. So 50,000 into 25, we have rejected 1,250 shares. So when we reject, cash is going out. Cash account credit 1,250 and share issue account debit 1,250. So the remaining shares, that is 5,000 minus 1,250, that is 3,750 shares is we are going to allot. So the shares that we are going to allot, share issue account will get debited 3,750 and stated capital will get credited 3,750. Okay. Then company made a rights issue 1-for-1 basis 20 per share. So for all those who own one share, they have the right to buy one share. Okay, so we have issued 150,000 shares. So which means in issue, so which means we are going to issue 150. Everyone has the right. Wait 1 minute on the AC, it's hot. Okay, so because we have 150,000 shares in issue, okay, they have the right to buy 150,000 shares. So 150,000 into 20. So if it's a rights issue, it's nothing much. Okay, we are going now, because 1:1 means 150,000 shares in issue, so they have the right to buy 150,000 shares. So when for rights issue, we are getting the money. Okay, so then cash account gets debited 3 million and stated capital will get credited 3 million. Then they are saying company made a bonus issue of 1-for-5 shares. Okay, so now because this question has not mentioned anything, now think, initially we issued 150,000 shares, then we made another 150,000 shares under rights issue. So now we have 300,000 shares. Okay, so for all those who own 5 share, they will get 1 free share. So we have 300,000 shares divided by 5 is how much? 5, 10, 15, 20, 25, 30. 60,000. Okay, so we are going to issue 60,000 shares free of charge. Okay, since they did not tell us the rate, I go with the original rate 25. So 60 into 25 is how much? 1,500. So rights issue, bonus issue means we're using the money available in our reserve. We are taking 1,500,000 out from the reserve. So reserves will get debited 1,500,000. Stated capital will get credited 1,500,000. Okay, so income tax paid includes 900,000 paid for the previous year and the payments made for the first 3 quarters of the current year. Income tax liability of the last quarter of the current year was estimated as 500,000. So if you take a look at the income tax double entry, your income tax estimate for the year double entry is going to be your tax account debit, provision for tax account will get credited. Okay, so when you pay income tax, okay, cash is going out, cash account credit, and provision for tax account gets debited. Now basically I told you all the profit that we calculate and the profit that's taken into consideration when calculating tax are two different profit. Okay, so we sometimes the tax that we estimate for last year might not be the accurate figure. We might have overstated the tax or understated the tax. So if we have over provided, if there is an over provision of tax, the double entry is going to be your provision for tax account will get debited and tax account will get credited. If there is an under provision of tax, okay, your tax account debit, provision for tax account will get credited. Okay, so income tax paid includes 900,000 paid for the previous year and the payments made for the first 3 quarters of the current year. So if you take a look at your income tax paid, we have paid 1,900,000. So when you pay cash account credit, provision for tax account gets debited. Now out of this 1,900,000, 900,000 was for last year, and so which means for the first 3 quarters it's 1 million we have paid. Okay, so if you take a look at your trial balance, your provision for income tax is 800,000. Based on last year's estimation, we have estimated that we have to pay 800 only last year, but actually this year we paid 900,000. So last year I provided 800 and paid 900, means I have underestimated 100. So for underestimate, your tax account will get debited by 100,000. Provision for tax account will get credited by 100,000. Okay. Provision for tax brought forward is 800,000. Then they say income tax estimate for the last quarter of the current is 500. Now for the first 3 quarters you have paid 1,000. For the last quarter it's 500. So your income tax estimate for the year is 1,500,000. So income tax estimate, your tax account gets debited, provision for tax account will get credited. So you close your tax account, you will find the tax expense for the year. You close your provision for tax account, you will find the carrying down balance.